First of all, our piece of rough work, it works out how much profit has been made from all the money invested in the business. So the operating profit is the one that says, well, money's been invested, hopefully it's been used efficiently, and this is the profit we've made from using it. From this, in this example here, 100 grand operating profit, we've had to pay two groups of investors in the business. The first is the banks, they always get paid first. Then the second is going to be the preference dividend shareholders, because they get a fixed amount of money, and whatever is left, we'll decide how much of that is going to go to the ordinary shareholders. So the operating profit, if you're doing a ratio that is looking at efficiency in terms of the overall business, then you look at operating profit. If you're talking about something to do with ordinary shareholders, and would the ordinary shareholders feel that their money has been efficiently used, then you look at the ordinary share profit. So that's just the general why we need to do that rough work. So the current ratio, anybody, so either a bank or an existing investor or a potential new investor will be worried, can we pay our bills in general? So this ratio talks about just the general ability. Are we managing our cash and our stock right? So we'll always have plenty of liquid assets available to cover our debts. We're looking for a figure here of 2-to-1. A bank would be interested in that because the bank is worried about getting paid interest. And the big worry is if this is poor, then bankruptcy is a real possibility. Same story for asset test ratio. We would take out the closing stock simply because that's cash that's tied up. And it's going to take quite a while for that cash to turn into, for that stock, which is tied up, to turn into cash. So therefore, we ignore it when we work at the asset test ratio. So in an emergency situation, if we need to get cash in a hurry, we don't include stock because it would be too difficult to actually turn into cash quickly. So the shareholders' funds is all the money invested by the shareholders. The capital is money invested at the beginning, and the reserves would be the profits that we've saved over the years, which is belonging to the ordinary shareholders, not belonging to preference shareholders or the bank. It's belonging to the ordinary shareholders. It's their money, and it's tied up in the business. So if you're looking at doing bank ratios, you won't talk about these shareholders' funds. That's not really for banks. It's very much for ordinary shareholders. So the shareholders' profit, you have the formula there for that one. Now, and basically what that does is how much profit was made only from the money put in by the ordinary shareholders. Because the other two are like expenses, like bills that have to be paid and taken out of, so it's the money left over once those two are paid. So the cash sales now, I'm going to take the two formulas together. So you've got, there's a debtor's days, or in this case you've got multiplied by 12, so it's debtor's months. And you also have creditors, so it'll be creditors over credit purchases months. Now take those two formulas together. And what I'm going to do is I'm just going to put that beside it. So we've got creditors over credit purchases times 12 over 1. Now, by putting those two together, the debtors given is how long are we allowing our debtors to pay up. So typically in the example you've got here, it's taken 3 months for our debtors to pay us the money they owe us. If we're paying our creditors in 2 months, well then we've got a negative cash flow. So the big word that you want to talk about for this is cash flow. That would need to appear in your answer. So FLOW. Right. So is it the cash flow positive or negative? So if we're getting paid quicker than we're paying out money, we have a positive cash flow as a result of doing business on credit. If it's the opposite, we have a credit. If it's the opposite, then we have a negative cash flow situation. Okay. So return on capital employed. So this is how much profit is made from all the money invested in the business. Now, a key word I would talk about here is efficiency. I'm just putting this down as we go through. So efficiency of the use of the funds. Funds invested. And I would also make sure that you mention we're going to compare it to the bank rate. So our reference, so the bank rate at the moment, if we think of a figure of about 2%, we would look to be earning, if the business has been efficient in the way it uses the funds, we should be earning a lot more than 2%. take into account the risk that we're taking being involved in this business. So the earnings per share, well, this is just from one share, how much profit has been generated from that one particular share. So you've got net profits minus preference dividend. I tend to use I would talk about ordinary share profit instead. It's the same thing, but I just try and get thinking about ordinary. This is the profit of the ordinary shareholders. So price earnings, it talks about market confidence in the future. So market confidence in the future. So if we made a reasonable profit, then we would expect the share price to be reasonably high. If our profit is poor, then we expect our share price to be reasonably low. But if the price earnings, so we're looking for a price earnings ratio somewhere in the region of 10 to 1 or 10 years. So it'll take 10 years for us to earn back the money invested in the business when we bought shares. If the answer is 15, well, that means people are willing to pay a much higher price than the profit would deserve. So there's something else going on in the business, like maybe we've just invented something new that customers are very happy with the business, whatever. So there's something else other than the profits which is making people want to buy shares in this business. Now, return on equity funds. This is how much money is made only from the ordinary shareholders. So I think your formula you have here, so it would be ordinary share profit, okay, divided by equity funds, which is shareholders' money, ordinary shareholders' money. So how much money has been made only from the ordinary shareholders' money compared to the amount that they've actually put in? And remember, equity funds, just put down beside it. So that's ordinary share capital plus reserves. So we're taking out preference shares because they get the set amount of money every year, and we're taking out the loans. So that's not something that banks would look at. So if you're doing this in terms of, question B, this here, you'd be really looking at ordinary shareholders. If the question says, should you think about buying shares in this business, or would the existing shareholders be happy with the way the business is operating? Okay. So dividend cover, just basically, if you get an answer of 2 times, that means we're half, so turn it upside down, half of the profit that has been made is paid out in dividends. If you get an answer 3 times, it means we're earning 3 times the amount of money just to pay in dividends. So 1/3 has been paid out in dividends. So it's basically how conservative are we being in deciding, do we give loads of dividends out to our shareholders and keep only a little bit? Or do we give very little dividends and keep more money in the business? So we're like saving money in the business. So in the future, when we want to expand, we won't need to go and borrow because we'll have loads of money in saving. That's a very sensible, very conservative approach. And it's the type of thing, if you want to invest money in a business long term, you'd be happy about that. But if you want to make a quick buck, you want to make profit quickly and get dividends, well, then you probably wouldn't be happy with that kind of approach. So if you turn the formula upside down, so if you get a figure, for example, of 2 times, that means that, turn it upside down, half of the money invested in the business, half of the profit generated from the ordinary shareholders' money, half of that has been paid out. So the other half must have been getting retained. So that's again something the shareholders would be interested in, whereas the interest cover is a similar, like how much profit or how many times are we covering our profit? Or again, turn it upside down. If we get an answer of 2 times, turn upside down means half of the profit that's been generated from the business is been used to pay off interest, which doesn't sound like there's an awful lot going to be left to pay ordinary shareholders and to have a safety cushion and be retaining profit. So if you get a figure of 5 times or more, well, then that means that we're earning 5 times what we need just to cover our interest, which shows that the burden of keeping on servicing that loan is not a major problem. Something obviously the banks are concerned about, but also you'd say shareholders, if we're paying loads of interest, shareholders would be worried about the future of the business as well. Now, the period to recoup price. This is about, if we think about buying shares in the business now, how long would it take us to get our money back based on how much we're paying out at the moment? And you'll give an answer of something years. Very similar to the price earnings ratio, just so we know. Just moving on to the rest of the things that you have here. So you've got, okay. So the rest of that, I presume, is straightforward. So this one here, you're trying to work out cost sales average stock. So that's stock turnover. Now there is no target figure here. It depends on the industry you're operating in. So if you're selling something like food, well, you're going to be replacing your stock very quickly. So I would imagine your typical piece of food you buy in, you're going to have to sell within a few days. So you might have, it might be turned over 150 times a year will replace our average stock. Whereas if you're a jeweller's, maybe you might be replacing, like you might buy rings and you might have them sitting in your warehouse or on your shelves for maybe a month before you ever start selling them. So maybe your stock turnover could be 8 or 10 or 12 times. It depends on the industry you're selling in. What do you think is an appropriate period of time for this business to have those goods in stock? Because if they're in for too long, then it means that they could go obsolete, or they could start going off. If they're too quickly, maybe we don't have enough stock, so we have a chance of possibly disappointing customers when they come in to try and buy goods. Return on shareholders' funds is the same as return on owner's equity. So I'm just going to put that down there beside it. So return on shareholders' funds, on SF or OSF, is the same as return on owner's equity. So this is how much profit is made just from the money invested by the ordinary shareholders. The same thing. And dividend yield it's something from, like, banks wouldn't be really worried about it, but it's shareholders, and especially somebody who is looking to be a potential new shareholder would look at this formula to say, well, based on the dividends we have at the moment, if I'm going to buy the share at today's market price, would I be happy that I'm going to get a much better return than if I put the money in the bank? Now, obviously, we're hoping that the business is going to make more money than just what it pays out in dividends. So we would tie in with that the dividend cover formula, so that if we realise that if we get an answer to this formula, for example, 5%, but it turns out that our dividend cover is 2 times, well, then our earnings yield, how much has been earned for our money, will be twice the answer I get for dividend per share. Hope that makes sense.